Hello everyone, and welcome once again to another of our investment update videos. There's no doubt in anyone's mind that we are moving into a fascinating investment scenario as the globe reopens from the COVID-19 pandemic. With bifurcated equity markets, rising bond yields, and the threat of inflation, there's no doubt that opportunities present themselves for investors. However, it is clearly apparent that careful management is needed. And who better to discuss this with Head of Equities at Royal London Asset Management, Peter Rutter. But before we start, please, if you have not subscribed as of yet to the channel, hit the subscribe button below along with the notification bell so you don't miss out on any of our weekly investment and financial planning content. So let's get into it. Many thanks for your time today, Peter. At the end of 2020 and moving into the beginning of 2021, all discussions have been centered around growth versus value equity. Is it truly that binary?
Well, potentially, and last year was extraordinary. Growth portfolios, or the growth index in global equities, outperformed the benchmark by 17%, 17, and the corollary of that is value underperformed the benchmark by -17. So, it's a 34% difference between your standard growth portfolio and your standard value portfolio. And we have about 50 years worth of data, and that is the most bifurcated it's been. So it clearly dominated returns last year. Whether it does going forward, we don't think it will be anywhere near as dominant one way or the other. But it's clearly a hot topic because of that extreme divergence that we saw last year.
Yeah. Recent days and weeks has seen a significant steepening in developed market sovereign bond yields, and started in the States. It seemed to be spreading out, and certainly the UK gilt market's been hit quite heavily. What do you think the effect that this will have on equity markets throughout the year?
Yeah, that's a really important question. And I think it depends why bond yields are rising. I also think it depends how far bond yields rise. And finally, it depends whether that rise remains in the control of central banks or not. So the impact on markets will be related to those three dimensions in our view. And maybe if I just take each in turn slightly. So why are they rising? Well, bond yields can rise because investors get more excited about economic recovery and riskier assets making a comeback, like equities or high yield. So they take money out of fixed income and government bonds, and that causes their yields to rise. So that's a kind of good steepening of the yield curve. An alternative reason, though, why government bond yields might be going up is that if investors think inflation is coming back, and therefore they need more return on government bonds to overcome inflation. And that's a very different reason for bond yields to go up, and there's a very different impact on equity markets. I think at the moment it's actually a bit of both that's causing the rise in bond yields. But whether or not it's led by the economic recovery or by inflation expectations will very much impact which bits of equities do better than others. Turning to the second area around how far they go, I think as long as they go up, about as far as they've gone, it's okay to support equity markets. But if they go much higher than here, it could cause equity markets to fall, simply because that discount rate, that yield available in bonds gets so attractive again. If it got to sort of 2% or something, that might draw in a lot of long-term savers taking money out of equities. So as long as they don't go up too fast or far, then I think it's still supportive for equities. But if they keep gapping up, that will be tough for equity markets. And then in terms of the control element, the third element, that's a really interesting question. We live in a world dominated by central banks and monetary policy, and there's talk of the bond vigilantes of the 70s and 80s being back in riding out again, which really could take control back from central banks. I think if we saw a loss of control in bond yields from central banks, then that's a pretty messy scenario for all investors across most risk assets. We don't see that at all, but I think it's important that whatever rise in bond yields we see remains controlled and sort of steady rather than out of control, in order to support asset prices. So you can probably tell from the answer to that question, loads of elements to the importance of the bond yield on equity markets. But come back to that, it depends why they're going up, how far they go up, and I guess in what rate of control they go up. But that combination of factors will lead to very different impacts on different parts of the equity market, we think, going ahead.
Yeah, absolutely. And I think the complacency with regards to equity gains being, a pre-written concept is kind of become slightly different over recent weeks. Focusing upon that, and obviously looking at your positioning at Royal London Asset Management, where do you feel investors should be focusing for this year, and obviously looking out over the longer term?
Yeah, so I think there's a challenge facing equity investors and to be honest, nearly all investors, which is that yields on risk assets are pretty much at record lows. So first of all, that would make us wary of chasing risk too aggressively. Now, we don't consider the bulk of equities to be that risky in the very long term because of their compounding wealth creation and inflation protection. But what I mean by that is avoiding the riskiest of risk assets, simply because they're very sensitive to potentially rising bond yields and discount rates. And then within equity markets and asset classes in general, when the overall envelope of expected returns is quite low, really for us, that's when stock picking comes to the fore. So whether it's equities or any asset class, I think when lots of things are quite expensive, it becomes even more important the specifics of what you're buying. And then just building on that, what's interesting us most at the moment is the parts of the equity market that are quite boring businesses, quite frankly. They're not your US sort of growth and tech stocks and healthcare concept stocks. They're just pretty dependable, steady, sustainable businesses doing fairly plain vanilla stuff. I'll give an example like Verizon doing telecoms in the States, or Bridgestone making tires in Japan. Fairly standard things, but some of the cash flow yields on these companies are now approaching double digits. So in a world where you get 0 to 1% in the bank, some of these more steady eddy mature equities have got exceptionally attractive yields potentially, as long as you think that they can sustain themselves for the next 10 or 20 years. So there are parts of the more mature parts of the equity market where, whilst they may not be the raciest of the most exciting tech and innovation stocks, they've actually got very attractive valuations and decent long-term fundamentals. So that part of equities, we call it the mature part of the life cycle, is particularly interesting to us at this juncture, especially with rates and yields rising.
Yeah, I completely agree. I think it's important that you look at where you're investing, and not just assume that everything's going to rise, and kind of ignore what we went through last year, and get back to possibly basics with regards to investing, looking at the bottom up stock pickers, and really be careful, but carefully managing your investments. Peter, it's been an absolute pleasure. Thank you very much for your time. You take care, stay safe, and I'm sure we'll catch up soon.
Thank you.